You are in big trouble if you think that because you made some money in the stock market that you're a super smart and great investor. Because what you may not realize is that there is another huge factor at play here, and that factor is luck. And if you immediately feel annoyed because I mentioned that you might just be lucky in the stock market, well then you should definitely be watching this video. It's going to save you a lot of money. And I understand getting offended at someone insinuating that you've just been lucky, because there's always been a huge debate over any successful person, whether it was luck or skill. We've all heard the people, which we call haters, say, oh yeah, that guy did well, but really he was just in the right place at the right time. It was all luck. He's actually an idiot. And then if you ask the successful guy, he says, no, I worked really hard for this. That's why I'm successful. So we'll talk about the answers to that debate in a second here. But more important than debating whether you're lucky or skillful is the actual lesson that comes from that. Because there's another side of luck that you probably haven't thought about that's actually way more important, and we're going to break it down in this video. And like I said, this is really going to help you out in the future in the stock market. And not only in the stock market, but in life too. And I was thinking about this concept after reading Morgan Housel's book, The Psychology of Money. And it's actually a really good book. And I was skeptical because so many people liked it, and I usually don't like what everyone is, all hyped up about. But no, the hype is real for this one. This is great. So the first question that we got to answer, which is a really difficult question, is how much of success is because of luck? And we're talking about the stock market here and everything else too. And like I said, extremely difficult question because there really is no way to actually measure it. So in the book, Morgan Housel actually asked Robert Shiller, who you guys know is the Nobel Prize winner in economics, this professor looking guy right here, or you at least know the name Robert Shiller, of course. But he asked him, what do you want to know about investing that we can't know? And he responded, he wanted to know the exact role of luck in successful outcomes. And like Morgan says here, that's a great answer because it's hard to quantify luck and rude to suggest people's success is owed to it. So the default stance is often to implicitly ignore luck as a factor of success. Like I said, if you were annoyed that I said you were lucky instead of a good investor, you're not alone. Like, we would all be annoyed by that. So a great example of this debate between luck and skill is America's #1 sex symbol, Bill Gates. Look at him. I mean, we already know you got to be kind of lucky to look that good. But apart from that, what do we know about Bill Gates? We know he is a billionaire, one of the smartest people in the world, extremely hardworking, founded Microsoft, obviously. But what you may not know is that his high school was one of the only high schools in the country that had a computer. So yes, we would all agree Bill Gates, super hardworking, genius, but we can also say that, hey, he got lucky because of where he was in that period of time. This was like 1968 or something. So this was before anyone really had a computer. But this specific high school that Gates went to did have it. And you can see how his life took off from there, in a big part due to that computer. Bill Gates even said in a graduation speech, he said if there had been no Lakeside, which was the school he went to, there would have been no Microsoft. So Morgan Housel does the math here. He says in 1968, there were roughly 303 million high school aged people around the world. 18 million of them were in the US. 270,000 of them lived in Washington State, and a little over 100,000 of them in the Seattle area, which is, where Bill Gates is from. And only about 300 of those people attended Lakeside High School, which was the only one with a computer. So start with 303 million people and end with 300. And Bill was one of those 300. So is it luck or skill? Well, it's both. Another great example of this debate is Benjamin Graham, and you know him, from the Securities Analysis, the book that every value investor keeps under their pillow, which is why they're always grumpy because they can't sleep right. So again, going back to the book, Benjamin Graham is one of the greatest investors of all time, the father of value investing and the early mentor of Warren Buffett. But the majority of his success is actually due to him owning an enormous chunk of Geico stock. That's where most of his money came from. And by his own admission, that broke nearly every diversification rule that he laid out in his famous texts. So when he wrote about his success in Geico, he was like, you know what? I don't know. Is it one lucky break or one supremely shrewd decision? Can we tell them apart? No, we can't. Not easily. Again, a lot of luck there. You could say the same thing about Warren Buffett. I'm a good investor. I like Dairy Queen and Coke. For Buffett, you could say a huge part of his success, apart from being very smart, of course, is that he was born in a time period where that certain strategy really took off. He profited off the backbone of America, and America taking off. And his returns outside of that period haven't been as great. But okay, if we accept that luck is a significant part of every successful outcome, what does that actually mean? Well, it becomes extremely important to understand this concept when you start looking at the other side of luck, which is risk. And you'll see why in a second here, but luck and risk are two sides of the same coin. And if you don't respect one, you're not going to respect the other. And that's when you're going to run into a lot of pain in the stock market. Now, going back to the Bill Gates example, you may know that Bill Gates met Paul Allen back in high school. And then, they formed Microsoft. It was a crazy story. But there was also a third person in their group, a guy named Ken Evans. And he was just like Bill Gates. He was actually more similar to Bill Gates than Paul Allen. They were a better fit. And he was just as smart as them and everything. So then what happened to Ken Evans? Why haven't we heard about it? Well, he actually died in high school in a mountaineering accident. And it's extremely sad, especially considering what he would have been now. And think about what are the chances of that happening. Every year there's around 36 mountaineering deaths in the United States. The odds of being killed on a mountain in high school are roughly 1 in a million. So again, what do we say? Risk and luck are two sides of the same coin. So Bill Gates experienced a 1 in a million luck by ending up at Lakeside. But Ken Evans experienced 1 in a million risk by never getting to finish what he and Gates set out to achieve. The same force, the same magnitude, working in opposite directions. It's a difference between someone being extremely lucky and extremely unlucky. Now think about how we treat the two opposites of success and failure in our society. When someone is successful, again, it's rude to call it lucky, right? So we say, oh, they're very smart, very skillful, they did everything right. So we don't talk about the luck, even though there is a significant portion of it. And on the failure side, we do the same thing. We don't just say, oh, that person was unlucky when their business fails or something. We say they must have messed up and done something wrong. Because this guy over here was successful. If this guy failed, then this guy sucks. He's an idiot. And we attribute it to a lack of skill, not a lack of luck. We don't include the idea of risk. Because think about any business venture. No business venture is 100% sure shot, right? A really good opportunity would have like an 80% success rate. But guess what? With an 80% success rate, there's still a 20% risk that you fail. And sometimes you'll fall into that 20% and it won't be your fault at all. That's just the risk. Because when we're saying there's an 80% chance of success when you do everything right, well, there could be a 20% chance of failure even when you do everything right. And I got this lesson thrown into my face recently. You guys know that I run a few businesses. And when they're doing really well, I'm like, oh, good, I'm a genius, right? I'm so smart. I'm a great operator. It's not luck, it's skill. I say that like an idiot. So on the flip side, one of my businesses actually collapsed recently. And what did I once again think? Oh, I did something wrong here. I'm an idiot. I can't believe this happened. But then when I was doing a post-mortem with my business partner, we're like, wait a minute, we actually didn't do anything wrong. We made all the right decisions, but the business still collapsed. So at that point, after analyzing, you could say, hey, maybe we fell in that 20% of the risk. Not that we did anything wrong, but there was always risk to begin with. So the lesson here is to understand that there is always going to be that risk, and you're absolutely going to face it at some point. It's just probabilities, right? So what do you do then? Well, you got to manage the risk. So going back to this business example I just gave you, I've seen this happen before. I have seen things collapse, and because of that, because of my understanding of the risk, I personally keep a bunch of just straight up cash in my accounts. Because I know how volatile running businesses can be, I also know to protect against the risk of these businesses collapsing by keeping a lot of cash. And when I talk to other entrepreneurs, including my business mentor, they do the same thing. And my mentor has a crazy level of wealth at this point, but he still keeps a bunch of cash. Again, managing the risk. Because once you accept that, hey, a few of these businesses took off, yeah, I did a good job, but there was also a lot of luck, you can also realize that, hey, even if I do a good job on these other businesses and they fail, then, there's always going to be that risk. And I need to guard against it. It's not really up to me. Not fully anyway. You can't always dictate the outcome, especially in something as complex as, say, markets or the business world. It's not all up to you. It's a very complicated system. And the idea of respecting risk, of course, applies to the stock market. You guys know I rant about risk control all the time, which is why I'm always talking about having that risk control in place, cutting your losses. I talk about how the idea of just blind diamond hands and buying the dip, how stupid it is. Because you got to understand that you can lose, and not only lose, but lose big. The stock market isn't some surefire thing. There is always that risk. Just because the average is 10% a year doesn't mean you're going to get that average. People who got screwed in 2008, they're not getting it. And this is why I love systems when it comes to investing, like the Fallible system that I always talk about as well. Because with the system and with data that you're analyzing in the market to create the system, you can test and calculate how your system does in multiple different markets in multiple different cycles to really understand what the probabilities are. So when you lose in a trade, you could put it into the context of what a normal distribution will be. So in more simple terms, what's one of the hardest things in investing? It's when you lose on a trade or investment and you start wondering, oh, did I do something wrong here? Is my strategy or system broken? Or was it just the risk that was involved? Again, this trade had an 80% probability of making me money, but for some reason it didn't. So did this just fall into the 20% category? Or did I misread this and this actually wasn't a good trade? It's a difficult question, which is why a system makes it so much easier. Because with a system, you've run hundreds of trades so you could see how many win versus how many lose, and how much you make when you win versus how much you lose when you lose. Having that information and being able to look at all the risk puts you way ahead of everyone else, because a lot of people in the market, they're just flying blind. So a good system that helps you understand risk so that you can manage it too, that's extremely important. And there's another huge lesson that comes from all of this, from understanding that luck and risk are two sides of the same coin. And the lesson is in how you evaluate other people's success. And then of course, whether you want to copy what they've tried to do. So here's an example of an old tycoon named Cornelius Vanderbilt, and he had a railroad empire. Well, after he finished expanding his empire, one of his business advisors said, hey, you know what? You actually just broke every law in the book with everything you've done. And his response was, you don't suppose you can run a railroad in accordance with the statutes of the state of New York, do you? Basically saying, who cares about the laws? Now, Vanderbilt here was extremely successful. So you could look at this in two ways. You could praise him as being an amazing entrepreneur who broke the laws and wouldn't let anything stop him. Or you could also say, oh, that guy was a criminal. Now, of course, in his example, because he was successful, everyone says amazing entrepreneur. But it could have easily gone the other way. He could have ended up in jail. And then what would you say? Wow, what an idiot. Why did he break all those laws? You could say the same thing about John D. Rockefeller. He frequently circumvented the law, and a judge once called his company no better than a common thief. Once again, one of the greatest entrepreneurs of all time, right? But also, it could have ended up very differently. Now, if you don't understand luck and risk, you don't know how to evaluate that. Because if you're managing your risk, you wouldn't necessarily copy one of those people. Would you tell someone that, hey, yeah, build your business and break every law? Who cares? No, you wouldn't say that, just like you wouldn't tell someone to go run in front of a truck. Because that guy survived and, the truck went over him, you'll probably survive too. No. That's just not true. So as it turns out, the extreme examples in our society of the super successful people, they are probably the worst things to copy, because there's a much bigger factor of luck in their process than what we talk about. And Morgan Housel had some great examples of this. Countless fortunes and failures owe their outcome to leverage. We know about that in the stock market, right? The best investors put all their money into something and then they make a fortune. The worst investors also do that and lose everything. The best and worst managers drive their employees as hard as they can. It worked out for Steve Jobs being the type of terror CEO that he was, but what about your manager at work when he's the worst? He's no Steve Jobs, right? The customer is always right, and the customers don't know what they want are both accepted business wisdom. So really, the line between inspiringly bold and foolishly reckless can be a millimeter thick and only visible with hindsight. So really, you sometimes might hurt yourself trying to copy an example of one of these extreme cases. You'd likely be better off learning from more general principles that apply to many different scenarios. So for example, the general principle that people who have control over their time tend to be happier in life, that's something you can work with. And this once again leads back to investing, because you might not want to copy Warren Buffett exactly. That's not saying there's not things to learn from him, but what he did back then might not work for you today. It likely won't. So going back to the system we use at Fallible, it's a momentum system. And the reason why our system works even as the market changes is because the idea of momentum is so robust. We know momentum in its broadest form has been around forever, right? You see it in basketball teams when they catch a hot streak. You see it in your personal life when things are going good. Usually a bunch of things go good for you in a row. It's a universal principle. Of course, it applies to the stock market. Why do stocks trend higher for so long? And it's a robust idea that's going to continue to be here forever. And that's what backs the system. It's not some super specific strategy that only worked in a particular market based off the market wizard who had this job in this area and had this flow of information. It's much broader, which means you're going to have a more successful time trying to implement it. And this leads to another extremely important point about luck and risk that is actually dependent on the year that you were born. And we made a whole video about it right here. You'll see that the decade that you came up with has a huge effect on what success you'll have in the market. So in the video, we talk about why that is, and then of course, what you can do about it so that you can be successful regardless of when you were born. So click this video right here and I will see you over there.